let's kick off with the economy. So the economy isn't as rosy today as it was at the end of 2024. So what's going on? What are you seeing in the data?
Yeah, well, the information that has been brought to the forefront since the end of last year with regards to tariffs and other political activity, the crux of it is there is so much uncertainty that it's really hard to either get really optimistic or really pessimistic. So if you'll recall, coming into this year, I was really optimistic on the consumer. Good balance sheets, good earnings growth. I thought that would afford consumers with a high level of ability to spend in a discretionary manner. I'm not going to sit here and say that has changed materially at this point, but it is just too early to tell. So I will walk through in very simple detail what has changed, what has not changed, and what I think we should focus on for the next few months.
Great.
Start with the labor market. Realistically, the picture has not changed materially. Unemployment rate, we're at 4.1%, a small uptick from the 4% roughly that was seen at the end of last year, and well below the long-term average, recall. Job additions, new jobs added month to month, we've seen a little bit of a downtick, but let's just call out the fact that the 3-month moving average of 200,000 jobs added a month, that's new jobs in the U.S. economy, is greater than the average for all of 2024. Wage gains, what are people getting paid? That continues to outpace the overall level of headline inflation. These are all good signs that individuals from an employment perspective are not deteriorating rapidly.
And that being said, they should be able to spend. So they're working, people are working, more jobs are being added, and people are getting paid more. So they should be able to afford elevated inflationary costs or cost of living.
Right, and I would call it back to the fact that what we called out at the beginning of this year is that individuals' balance sheets are just on really good footing because of 2 strong calendar years in the market.
Yeah.
So even though you have this elevated level of uncertainty, and the data hasn't been overwhelmingly good to start the year, I think you have a lot more wiggle room now than you have in past periods.
And just to be clear, that's called the wealth effect. So as portfolio values increase, people feel wealthier, and because they feel wealthier, they're more inclined to spend.
Yeah, and usually that is true. That is the wealth effect. Yeah. What's been different, at least in my opinion, through the first quarter of 2025, is that because there have been all of these changes to the political conjecture, and it's so publicized, I think that is showing up in spending figures.
Sure.
Retail spending to start the year has been a little choppier.
Yeah.
So the willingness to spend hasn't been there. That has no impact on the ability of consumers to spend.
Sure, and I think you're relating back to the tariffs and what the impact is of the uncertainty of the tariffs. And of course, that's going to create a cloud of questions that the labor market, labor market moves a lot slower. The data comes out more gradually. So we're able to react to these where tariffs are just thrown in our face, and we're wondering, what does this mean? How long is it going to last? What's the impact?
Yeah, and like I said at the onset, it is just too early to tell.
Too early to tell.
I'm not going to panic because it's too early for that as well.
Right.
But we're certainly going to be watching the data very closely because there's a very direct impact on the U.S. economy.
Yeah.
Right?
Yep.
The last thing I did want to call out, because we do get questions on debt all the time, specifically the fact that we've seen rising credit card utilization, we've seen overall debt at the individual level start to creep up. Yeah. And while that is true, I would say 2 things. That debt ticking up is all relative. So if you look back towards 2020 and 2021, right at the onset and immediately thereafter the pandemic, household balance sheets were in such good shape that, their debt was not really needed to be leaned on. When I look at debt, I think you have to look at it relative to something else, right?
Sure.
As on a standalone basis, just because someone has leverage, that doesn't really tell you anything. So if I look at the level of debt on average across U.S. households, I like to compare that to disposable personal income. So how much debt relative to what they can actually spend? Mm-hmm. Like, what does that figure look like? And to me, that's the chart on the bottom right-hand side of this screen. To me, we're still below what the kind of pre-pandemic trend was. So even though you might see publicized headlines around debt creeping up, debt utilization and credit utilization creeping up. Number one, that can be taken as a good thing because that flows through as spending in the economy. But the whole other side of it is relative to what? Relative to personal income and disposable income, that does not look anywhere even close to an area that would flag kind of in red to me.
Sure. So you have spending. You have we're watching the labor market to understand its effect on spending. We're watching debt, personal debt, household debt. You relate it back to spending. These are all great data points to understand what's happening in the economy. How are consumers driving businesses here in the U.S. economy?
Yeah.
Fantastic.
So, I mean, tagline is, it's way too early to celebrate, but it's far too early to panic.
Okay. Outstanding.